Welcome back to The Explainer. Now, if you've been watching the markets this month, you already know that August 2026 has delivered some incredibly complex and, honestly, pretty contradictory signals. So today, we're taking those raw intelligence briefings and transforming them into a clear, actionable narrative to help you cut straight through the noise. And to kick things off, I want to show you exactly why the stakes right now are absolutely astronomical. There is currently an unprecedented $3 trillion plus, literally just sitting on the sidelines in retail money market funds. Right now, it's comfortably yielding about 3.62%, but you have to understand what this represents. It is massive, pent-up market liquidity. We're talking about a coiled spring of capital just waiting for the right catalyst to deploy. So the question isn't if this money will move, but where exactly it's going to go when the dam finally breaks. So to track that $3 trillion, we've got a quick four-part roadmap for today. First up, a macro reality check. Second, the AI sovereign era. Third, we'll look at some hidden catalysts. And finally, the smart money toll takers. All right, let's dive right into part one, the macro reality check, and how we are navigating the Fed's tightrope. See, the Fed is currently facing a massive dilemma. Right now, the market implied probability of a September rate hike sits at just 40%. It's a literal tightrope. On one side, we have deflationary tailwinds holding steady, right? Headline CPI cooled down to 3.4% and core CPI decelerated to 2.5%. But on the exact opposite side, battling those numbers, we have some severe inflationary threats. Consumer resilience has really boxed the Fed in, and we still have major geopolitical risks, like the ongoing shutdown of the Strait of Hormuz, which is severely elevating oil supply risks. It's just a massive tug-of-war between cooling labor data and heating up supply chain realities. And because of all this macro confusion and the ongoing inflation battle, we are officially witnessing the death of what we call the no-brainer portfolio. For decades, investors relied on a very specific, comfortable safety net, the long-duration, nominal 10-year U.S. Treasury. But with yields currently sitting up at 4.69%, that traditional pillar of liquid, low-volatility safety, it's cracking. It simply cannot provide the negative correlation to equities and positive real returns that it used to. The old consensus is totally dead. Which means we're undergoing a massive paradigm shift in portfolio construction. Investors are completely abandoning passive safety nets. Instead, they are actively engineering their own protection. How? By moving heavily into alternative real assets. We're talking things like base metals to act as direct inflation hedges, tangible cash-flowing infrastructure that's insulated from tech cycles, and private credit to generate the kind of yield that sovereign debt used to provide. Okay, moving right along to part two, AI enters the sovereign era. We're talking about a mega-scale build-out here. The artificial intelligence supercycle hasn't just grown, folks. It has evolved into a mega-scale build-out. AI financing has moved so far beyond traditional venture capital mega rounds, it's almost unrecognizable. NVIDIA is literally partnering with BlackRock right now to mobilize a $500 billion infrastructure security class just to keep hyperscalers' data centers running. Meanwhile, Anthropic's upcoming IPO target is being priced at a staggering $2 trillion. $2 trillion. The sheer amount of capital being deployed here creates an extreme vulnerability if AI productivity fails to meet these absolutely massive expectations. And to actually fund these sovereign-level build-outs, companies are having to leverage monopolies. Take SpaceX, for example. While their AI compute division's post-operating losses, their Starlink satellite operation generated $4.29 billion in Q2 revenue alone. It is acting as a massive cash cow. SpaceX is taking that monopoly money and just aggressively funneling it straight into the AI engine. They're funding Elon Musk's target of 10 gigawatts of computing power and the launch of Grok 4.6. It is a masterclass in utilizing one dominant asset to subsidize a massive play for global AI dominance. Which brings us to part three, hidden catalysts and wildcards. Let's look at some serious market anomalies. So, a major cybersecurity threat has completely blindsided the corporate world this quarter, and it is a wild one. North Korean corporate infiltration. And look, this isn't your standard hack. Thousands of North Korean operatives are forging U.S. identities using advanced AI to completely bypass initial corporate screening. Then they use U.S.-based domestic accomplices to proxy their IP addresses, successfully landing high-paying remote work positions within at least 8 major American companies. They operate completely undetected for months, and they systematically funnel millions of dollars in corporate salaries straight back to Pyongyang to directly fund the regime. It is an astonishing, highly sophisticated vulnerability in the modern remote workforce. We also have a massive wild card acting as a sudden windfall for corporate balance sheets. Out of nowhere, over 40 S&P 500 companies have received a combined $9.6 billion aggregate tariff refund, and it hit with remarkable speed. Apple alone absorbed roughly $2.2 billion of this pure cash, with Nike and FedEx taking nearly $1 billion each. Now, this is absolutely crucial to note because this non-operational earnings boost artificially sweetened Q3 performance for these heavy importers, completely masking some of the underlying consumer weakness we're otherwise seeing. And check this out. Here is some fascinating, purely data-driven analysis from RBC Capital Markets, highlighting a stark inverse correlation over the past year regarding market psychology and safe havens. As Donald Trump's political approval ratings have trended downward, gold prices have inversely surged, climbing 31.19% to an elevated $4,467.50. This specific data point really reflects how compounding domestic uncertainties are currently fueling a massive flight to this traditional safe haven, entirely independent of your normal rate cut expectations. All right, let's bring it all home with part 4, the smart money toll takers, and exactly where all that capital is fleeing. So, with the Fed on a tightrope, AI requiring literally trillions of dollars, and wildcards injecting chaos into the system, the answer to where the smartest money is fleeing is found in something we call toll takers. Case in point, in the first half of 2026, Bill Ackman's Pershing Square deployed $5 billion, strategically pivoting entirely away from an obsessed AI hardware market and exclusively into highly moated, capital-light global businesses. Now, you might be wondering, what exactly is a toll taker? Basically, it's a business with an oligopolistic market structure that just takes a cut of economic activity without taking on the heavy material risks. Think about S&P Global. Their moat is oligopolistic IP licensing and benchmark franchising. Or Visa and MasterCard. They connect billions of consumers with zero material risk, making them natural beneficiaries of inflation. As prices go up, their percentage cut yields more revenue, requiring absolutely zero additional capital expenditure on their end. They are the ultimate inflation-resistant monopolies. A perfect real-world example of this strategy in action is Pershing Square's aggressive reversal on Netflix. You probably remember they dumped the stock for a massive $400 million loss back in 2022. But now, in 2025 and 2026, they've re-entered the winner. Why? Because Netflix definitively won the streaming war, allowing them to just outspend rivals on scale. But more importantly, their massive advertising scale combined with generative AI ad targeting has enabled a staggering 90% conversion of earnings into pure free cash flow. Netflix is no longer just a content company, guys. It is a capital-light free cash flow machine, a literal toll taker on global attention. So, pulling this all together for our Q3 and Q4 outlook, we essentially see 3 main pillars. First, the Fed is walking a very dangerous dual data tightrope, fighting inflationary headwinds against deflationary labor data. Second, the AI hardware market is facing a massive sustainability test. And third, the smartest capital in the world is looking way past the immediate AI buildouts. Billions of dollars are currently fleeing into inflation-resistant capital-light monopolies that are trading at unwarranted discounts. Which leaves us with the ultimate question for your own strategy. We've seen that the old 10-year Treasury safety net is totally broken. We've seen that the mega-cap funds are actively engineering their safety through toll takers and infrastructure. So as the smart money flees to these capital-light monopolies, is your portfolio still relying on the dead consensus of the past? It might just be time to take a hard look at where your own capital is deployed. Thank you so much for learning with the Explainer today. I hope this structure helped demystify some of the chaos out there, and I absolutely cannot wait to dive into the next set of data with you soon.